Hello, it's Tristan here from Zebra Invest, and today I'm going through a question that I've been asked quite a few times. What is open market value lending and how can you use it? So open market value lending is usually known as market value lending. So when you're looking at what a property is actually worth out on the market rather than necessarily what you're paying for it. And the difference is when you look at a property online, it can be, say, something listed for £200,000, but it's actually worth £250,000. But it might just be where there's a reason or something in the background that's stopping people want to go through and buying the property. So there's two different types of lending you can use to do this. You can actually get open market value mortgages. So that means you can get a term mortgage that's 2 years or 5 years, let's say like a fixed term rate, and you can go off and find one of those products. And you can also use a bridging loan. And a bridging loan, again, they will look at the market value of the property, lend against what it's worth, not necessarily what you're paying for it. And you're going to need, if you're going to be looking to try and find these types of products and these type of loans, a specialist lender and a specialist broker to deal with it. Personally, I tend to work with Simon from Funded Finance. He's a great chap and he's helped out with quite a few of these. There's another chap you can have a look up online called Kevin Wright, and he's great with open market value mortgages, and he's also got another great video on YouTube if you want to have a look at it. So when you're looking at working with a lender, they're going to come out and value it in two ways. They're going to look at the market value of the property and they're going to look at what it's on the market for. So at the beginning, you're going to need to tell your broker how much you think the property is worth so they can base it on that valuation, and then they'll also value it based on the market value of the price. Typically, most lenders will lend on the lower value of the two of those, but this is why you're looking for a specific lender who will be happy lending at the market value of the property. It's the same kind of way that development finance works and the way they look at the GDV or the end value of a property. So you need to have a look at it and think, why would they want to lend that money? So there usually has to be a reason, and you probably get... So why would they want to lend that money? It needs to be a property that's going to be worth more than you're paying for it. There can be plenty of different reasons for this. So one of them could be, say, if you're buying a title split. So if you're buying a block of flats, you're actually going to be, say, buying 5, 6, 7 flats all together in one place, rather than buying them individually. So hopefully you've managed to agree a discount for the bulk buying of all those properties. You could buy a short lease flat, and if you've got a short lease flat, it might have, say, 60 years left on that lease, which a lot of people believe means it's cash buyers only. But actually what you could do is organise to extend the lease before you've agreed to buy the property. You then get that agreed, and then what you then do is find a lender who will then lend to you at the value of the property of what it's worth with this lease extension in place, and they'll actually pay for the lease extension on the way in. So the property rises in value during your purchase. The other bit it can always be quite good is if you can add value to the property before you've bought it. So that can work in a couple of different ways. But one of them could be is if you go out and get planning permission. So say for example in Southampton, which has got an article for HMO area, if you go out and get planning permission on a property to turn it into an HMO, you can lift its value probably by about £50,000 compared to its neighbouring property just because it's got planning permission. And in doing so, again, the lender's got an active reason to see why they're lending more money for it. Other things you can do to add value could be you could sort out a title problem. You could do something like an exchange with delay completion, and the idea there would be that you exchange, you could then get into the property, you might be able to do the refurbishment works before you actually own the property, put it all together, so then on the day that you're buying the property, you can get an open market value mortgage against what it's now worth and not what you paid for it. So now you've heard of open market value lending, you might be starting to get excited that you can use it for every single possible deal out there. The chances are it's not going to work for every deal. It's only going to be able to work for deals where there's an opportunity to add value or a real reason you're buying it below market value. If you're just simply buying it cheap, it's probably not going to work. And especially if you look at buying properties at auction, a lot of people seem to think you're getting a real bargain at auction, but at auction, that's actually where they decide that is the base value of a property because it's gone out to the whole market and everyone's had a chance to bid on the property. So open market value lending won't work then, or even if you think, oh great, we've managed to get a property for 20 grand below the asking price, well, chances are if you got it 20 grand below the asking price, you've actually got it at the true market value. So what you need to do is when you've gone off, and as I said earlier, and you've asked the valuer to go out, they've gone out and valued the property based on what the property's worth, and you probably need to give them some solid comparables to explain why it's worth that amount of money rather than the price that you've agreed it. Typically works best if you found something that's off market, or if you've got something out where you've worked direct with the seller to be able to achieve the higher value, but there are plenty of other ways of doing it. But you do need to make sure that you're always looking at what the end value of the property is going to be, and that could also be even like once you've refurbished it. So look, let's just think about it. I've got a few figures I can run through. When you are looking to borrow at open market value, and whether it's a mortgage or a bridging, typically they're going to lend you 70 to 80% of the open market value. So to give you an idea, if you agree to buy a property that's worth £200,000 and they'll lend at 70% £140,000 towards the purchase of that property. But the price you've agreed to buy it at is £150,000. So in that case, because you've got £140,000 the amount they're lending and £150,000 the price you've agreed, you've effectively got to pay £10,000 to be able to buy that property. You've also got to be able to pay your stamp duty, your legal fees, everything else in there. So it's probably about another £10,000. So you're going to then be able to buy a £200,000 property with a £20,000 worth of cash down, and that's only 10% down for being able to pick up that property. These deals aren't everywhere to be able to find them, but if you're going to spend a lot of time looking at and being able to research into them, they certainly are around. So why would I use it? And I mean, I have used it. So there's short lease property I bought in Harlow, or did as a joint venture with someone else. Bought it in Harlow. It had a short lease, it was about 60 years on the property. We agreed a price around about £100,000 and a lease extension of £10,000. We organised the lease extension privately with the freeholder, and then we managed to get a loan from Hampshire Trust Bank, and they lent money at about £150,000, which again, unfortunately with that one we could get 75% loan to value. So the total money that comes down to is about £112,000 is what they lent on day one. So you take all the numbers back and you can see actually in that case you could almost be no money down to be able to buy the property. Hampshire Trust Bank usually do want to see skin in the game, so they will still ask to see that you've got, say, £10,000 of your own cash in the property. But it can be a really good way if you want to go out, scale your portfolio, buy more opportunities with probably less cash. The only downside is you're not going to be recycling that cash that quick if you're using mortgages, but if you are using the bridging side of it, you should be able to refinance it and work it through. So another great way for using it is buying more properties. So if you're using it to try and go out and look at buying title splits, they can be a great opportunity because you can pick up a property where, say for example, it doesn't have planning permission in place. So a great reason for using open market value lending is that it can allow you to buy more property. So a great example can be going from buying a title split block of flats, or a block of flats that needs to be title split. And the reason being is you can add value on the way in. So it could be a property where it doesn't actually have planning permission. So if you're able to get a lawful development certificate, which I have done video before on title splitting, you can get that sorted to add the value to the property. And then when you go to purchase the property, all those flats can then be split into separate individual units. So on day one, you've managed to lift the value. In the case that I bought a property on Southwell Road in Norwich, we bought it for £300,000. I got a lawful development certificate on the way into the purchase, and then within 3 months I sold the whole property for £425,000. But doing it this way, you would have actually been able to go in, borrow the money against the £425,000 and not have to put so much cash into the deal. With that property, it actually needed a full refurbishment on it, and the idea was then to kind of do a buy, refurbish, refinance. So you can mix this method of lending, if you use the bridging side of it, along with then refinancing and pulling out your cash later. And then you can also use it when you're looking at, say, buying larger properties. So one of the things that people tend to not look at is the deals that probably just outside of the normal kind of what I call the builder-developer kind of price range. And a builder-developer price range is usually anything up to maybe about £300,000. Once you get a bit above that, you tend to get some larger properties that tend to be sticky that people don't typically want. These can be great for like subdivides and title splits. But one that we bought just on Carnarvon Road in Norwich, it actually has one property at the front and one property at the back. But again, the same thing, same approach applied. It was a much bigger property, but we can use planning permission to establish it as two separate houses, and again lift the value on the way into it. And that allows us to split it into each of them. And pretty much within about a week of us owning the property, it was worth £700,000 with a purchase price of £527,000. So hopefully you found this video really interesting and useful. If you do like it, please smash the like button at the bottom, subscribe to my channel, and if you've got any comments or any questions, drop them in below. Cheers.